If I could have your attention again, please. First off, I'd like to welcome the members and guests joining us through live stream. For them, again, my name is John Medlin. I'm a member of the executive of the Canadian Club of Toronto, and thank you online for joining us. I would also like to acknowledge our educational leaders table here today from the Rotman's Women's Initiative. So welcome. Thank you for being here. Our club has its fingers on the pulse of issues and trends that Canadians are talking about. Investment management is important to all, and the field continues to evolve with new distribution methods, new asset classes, and a growing number of talking heads on business news channels making noise. Today's event would not be possible without the generosity of our sponsor, Borden Ladner Gervais. BLG is represented today by Sarah Gardner at the head table. We appreciate your support. Now on to the main event. Let me introduce our panel for today. Today we feature an important discussion about the future of investment management from three senior leaders in the industry. They'll talk about how the investment industry is evolving and considerations that may impact growth going forward. Judy Goldring is the President and Chief Administration Officer at AGF. Judy is a renowned leader in the asset management industry and one of Canada's most influential businesswomen. Since joining AGF in 1998, Judy has held several roles with increasing responsibility, most recently serving as Executive Vice President and Chief Operating Officer. Jane Buchanan, CEO, Martlet Asset Management. Jane is the CEO of Martlet Asset Management, an independent asset management firm focused on liquid alternatives. Jane has served as director and chairwoman of the board of the Chartered Alternative Investment Analyst Association. I hope you have a good acronym for that one. That's a mouthful. She is also a board member for Girls Who Invest. Lynn McGrade, partner at BLG. Lynn is a partner at the Toronto offices of Borden Ladner Gervais and does work around the world. She is the Toronto regional leader of the investment management group and national leader of the firm's United Kingdom group. She represents both Canadian and foreign investment firms and fund managers on their ongoing legal issues. Moderating today's discussion is Andrew Willis. Andrew is a business columnist for the Report on Business at the Globe and Mail. He has been in the business communication and journalism for 3 decades, back when they used to publish the stock prices every day in the newspaper, I think. Previously, he was Senior Vice President of Communications for Brookfield Asset Management. The Canadian Club of Toronto is pleased to pass the podium over to you, Andrew, and our distinguished panelists.
Well, thank you very much, John. I am thrilled to be here and to talk about your money and your savings. Not much more important than that. And I'm pleased to be joined by 3 leaders and 3 innovators in the money management industry. And I am honored to be the token male for once. I thought we'd start today by giving each of the panelists a chance to sort of talk about what they see as the major issues in the investment management industry as they look forward. Because this is an incredibly exciting time in investment management. I think there's unbelievable opportunities. Markets have never been more part of the mainstream conversation. There's lots of wonderful strategies that all three of these executives understand far better than I ever will. But it's also a time when, frankly, markets are a little frightening. There's a lot of change. We've been through the 2007-2008 global financial meltdown, which I think gave a lot of us reasons to question the leadership of the investment management industry. So I'm looking forward to a really interesting discussion about where the world is going, what the trends that these executives see affecting all of us in our own wealth management and in the way that we work with our customers and with our clients. So again, I'm going to start out by asking Jane, I'll start with you. You've been a disruptor in a lot of your career. You've been on sort of the leading edge of introducing derivatives and working with liquid alternative strategies and things like that. Do you want to talk about your view from Martlet of the big issues in front of the industry right now?
Yes, so the big issues that we see is how are people going to make enough money for their purposes. So for example, you've got relatively low rates, and when you look around the globe, you've got a lot of countries with negative interest rates. You've got a stock market that goes up, but it can also go down very scarily. So how do you plan for year-to-year daily needs? And so what we see a lot of going on is how do you build very robust portfolios? What's interesting is after such a long bull market, almost a decade out of 2008, the great financial crisis, you see this bull market. People are very worried about when it's going to come. But what's happening is as you become defensive, your returns go down, yet the market keeps going up, and then you don't know what to do. So that's the problem that everybody's struggling with that I see from the world's largest investors, who I happen to have the privilege of working with, to very small investors. Everyone's got the same problem.
And Judy, you've been with AGF has been around for 60 years, got a history of innovation and of sort of reinventing itself. Do you want to talk about how you're looking at, especially at the Canadian market, how you see the industry unfolding?
Yeah, I mean, I think I see a lot of familiar faces, so I think we all recognize how much the industry is seeing disruption. And, you know, we start first and foremost with fees. Fees are under immense pressure, probably have decreased by about at least 10% over the last 3 years. And that's obviously causing margin compression in our respective organizations. But then you take it from there, and I think every element of our, I'll call it value proposition, is probably seeing some form of disruption. Starting with investment management, you're seeing the active to passive debate. You're seeing ETFs, you're seeing different styles of investment management coming into the fore, as well as AI coming into play. You then move to distribution, our distribution part of the chain. It's seeing massive disruption from the regulator. What's going to happen when the client-targeted reforms come through? Any day now, we're expecting that. That's going to force a smaller shelf space. And so how do we respond as a company to that structure of distribution? And then you look to just data and technology. It is a fast-moving, fast-paced environment now, where the opportunity set is to ensure we can provide for a very robust digital experience for clients, but at the same time, extract greater efficiencies. And so really every element of our business is under some form of disruption, which is a really interesting time. And then to just pick a bit up on what Jane was saying with the global environment, you know, there's so much, I don't want to say chaos in the United States, but there certainly is a lot of uncertainty that is being created by Trump. You know, we have challenges to globalization. The trade wars are challenging growth around the world. I think people now are going to be looking for where do you put your money. What's interesting, though, is you take that against the backdrop of double-digit global stock market growth in Canada. And so asset management firms really have almost a little bit of a sense of complacency, I think, because we have seen our assets go up, but the reality is you have to understand whether that's true organic growth or is it just market growth. And I think the irony is we have nervous investors who are going to wait, as you say, for the global recession, or if it does come or not, and how do we respond to it? And so it's a really interesting time, as you say, lots of challenges and lots of opportunities.
As someone in media, we really like things like Trump and like trade wars, bring it all on. We want the clicks. But I do recognize that the industry faces some huge challenges with this. Lynn, let's if we can, you can chime in. Judy mentioned the idea of regulatory change and the constant disruption that poses. Do you want to, obviously that's your specific focus with a lot of your practice. Do you want to talk about how you see the environment going forward with a specific focus on regulatory issues?
Yeah, and I think the regulatory issues have been large for the industry. They're creating when I first started practice, and if you had a family of 6 funds, we'd probably have 20 pages of disclosure to sell those 6 funds, and now it's over 100 pages of disclosure. So that's large. The cost of some of the new regulation when the CRM2, the new reporting regime for investors came into place. The industry had to invest over billions of dollars to keep up with the new technology requirements. So definitely, I think that has caused issues. And for me, the 3 big issues that's raised are scale. Scale is one thing that we've noticed. A lot of the medium-sized firms and smaller firms that we used to work with now have decided to exit the market, and the bigger, whether it's the banks or the insurance company or the larger independents, have just tried to increase their scale. And I think that's being driven, one, through the regulatory burdens or the regulatory initiatives that we're seeing, the increased cost of that. I think it's also being driven by the pressure on fees that you mentioned. It's also being driven by other risks that are out there that are growing. For example, cybersecurity risks. You need to protect yourself from cybersecurity risks, which means large infrastructure, and also class action risk. In my career in the 90s, we saw maybe 1 industry class action. In the last 2 years, I think we've seen 3 or 4. So all of those, I think, are driving scale issues. I agree with Judy. The distribution side is changing dramatically. We see the proposed rules. We don't know how they're exactly going to get implemented, but we do think there's going to be a lot higher standard of know your product, a lot higher standard of picking what is the best from a suitability perspective, or an expectation that it's not just something suitable, but you've made some analysis that you're giving one of the top recommendations. And if you think about a shelf space, if you have 1,000 things on your shelf and you have to come up with what you think is the best, that's a pretty hard job. So distributions are going to be dramatically reducing their shelf space, and that, I think, is going to cause a lot of issues. And I agree, finally, with disruption and technology is another big issue, I think, impacting the industry today.
So, Lynn, I'll stay with you for a moment. When you think of your most successful clients and the advice you're giving them, are there some themes in terms of the way that they're adapting to the challenges that I think the 3 of you identified in the last couple of minutes?
Yeah, well, I do think there's some themes that we're seeing as we're working with our clients in the industry and what they're doing. And sometimes the themes are divided up by the different investor groups. So at the institutional level, we're really seeing quite a focus right now on ESG, environmental, social, and governance issues. A really strong emphasis by the institutional investing market that will be incorporated into how they run the money. And I think that will trickle down into the retail world as well. We saw the OSC statement of priorities setting out that they do intend to start regulating disclosure of ESG because people are interested in it and want to know what people are doing. At the high net worth side, I think we're seeing a lot of disruption in the sense of really access to liquid alternatives, private equity, real estate, mortgage funds, loan funds, more alternative type products than we've seen in the past. And at the retail level, I agree with this concept of active versus passive. It was very actively based going back a number of years now. There's quite a mix of passive and active. And also, I think solutions, packaged solutions for investors are a focus. So instead of coming up with single mandates, they're coming up with, already where the whole package has been put together for a certain investor type with a certain objective.
And Judy, if I can get you to talk about the sort of the things that you're doing looking ahead. A lot of your clients would be financial advisors, especially in the more traditional parts of the business. Can you talk about what AGF does to work with the evolving role of the financial advisor, and maybe some characteristics also of successful advisors in this kind of an environment?
Sure. I mean, I think one of the things, three sort of key things we're approaching this as is on the distribution side with advisors, you have to change the conversation now. It's no longer, I'll call it the good old days. It may not have been the good old days, but it was the days when a wholesaler would show up, put a piece of paper in front of an advisor and say, this is the product you need, 5-star Morningstar, and off you go. And it's a single-purpose sort of equity-based product, fundamental long only. Nowadays, it's very much a conversation with the advisor. You have to understand what the advisor's book is about. You have to understand what they're looking for their clients, how they service their clients. Some of these corner office brokers have very unique books of businesses that will be interesting, to be honest, to see how the banks and the dealerships deal with it. because they have some very unique product offerings. And so to be able to get access into that channel is challenging, but it does require a different conversation. And so for ourselves, leveraging different sorts of product offerings that will be attractive to those advisors that are really not able to replicate them themselves. So areas like you mentioned, infrastructure, GSG, we have a global sustainability fund, we have different product alternatives, liquid alts. Getting into those offerings that do make a difference for the advisor and can sell something different to the client, but they cannot replicate themselves through an easy, indexed equity fund or passive vehicle. That's one of our approaches. And then, of course, is leveraging data and technology and being able to, first of all, we're applying a predictive methodology, predictive tool to understand the ebbs and flows of an advisor's book of business, so we know and we can predict to some degree whether they're going to sell or buy our particular product. So leveraging those sorts of data and analytical tools to really understand our book of business better, and then leveraging it for the client as well.
Is that internal intelligence, internal systems that you've developed, or is that are those solutions that you're buying to understand what the clients are up to?
Yeah, in most cases, there's solutions that we have worked with a vendor to acquire and moderate for our purposes.
And Jane, you have gone through an interesting evolution in the last couple of years in terms of what you're offering to clients. You were, for those of you who didn't read Jane's bio, she was running an extremely large fund, a $34 billion US fund, and then chose to become an entrepreneur again 2 years ago and launched Martlet. Do you want to just talk about the client need that you saw as you struck out on your own?
So a couple of things are happening. I work in the very large institutional space. So what we tend to see there is it's less about the structures and more about the strategies. And sometimes strategies trickle up, but more they tend to trickle down. And what we've seen is I ended up building the third largest fund of hedge funds in the globe in my prior incarnation. And what we saw is that people started adding hedge funds as a diversifier because they protected a lot. So even though you had a problem in 2008, hedge funds were often down only about 15%. We've also seen huge inflows into private equity and its variants, as well as commodity markets. So you're seeing all these large allocations, and for many large institutional investors now, they're just a standard part. Nobody thinks of them as alternatives anymore. What makes them alternatives is that they're not tied directly into the equity market. And so we have a problem, which is, do we just want to bet on the passive equity market to produce enough returns? Most of my clients are defined benefit plans to produce the returns to pay the benefits. You can't go. One of the jokes we have in the industry at my end is relative performance. Saying you outperformed doesn't pay benefit payments. So if you only made 2% and everybody else made -1, you feel like a hero, but that's still not going to make a benefit payment if it's a 6 or 7% thing. So they're very focused on absolute returns. And what you're seeing is the wholesale acceptance of these. Now the problem is that in the hedge fund industry where I come from, when I started in that industry in the 80s, the firm I worked with early on, we had very few. We had some big exposure to some hedge funds, but they were few and far between. And our database had about 400 in the world. Now there are about 6,000 in the world, and it's a $3 trillion market. It's a huge market. So the opportunity set changes. What we used to find, and nobody knew what a convertible was. I'm from Southern California. I'm an American, full disclosure. So when someone said, what's a convertible? They thought, well, was that the Porsche or the Chevrolet? What was it? And so these things have become wholesale parts of institutions. And the question is how to put it together. And what we've seen down in the States is, for all the reasons, particularly that Lynn's mentioned, scale is a very positive thing. But the problem is, as these pools get very, very large, it's hard to make money. And so then you're in this feedback loop where you're paying active management fees. But let me tell you, it's a lot easier to make good returns on a $2 billion fund than on a $20 billion fund in the liquid markets. And so that's one of the big things. And what I'm trying to do now is I'm out to reprice hedge fund fees. So I'm taking on the hedge fund industry, and I'm running around, and we'll see how this goes. But I've always been sort of a forward thinker. So I fought for transparency in 2000 when we launched my last firm, and everyone thought we were nuts. And now transparency and separate accounts have become a more standard part of the industry. So I've got a lot of angry hedge fund managers. In fact, I came up from New York where I was dragged in by a $40 billion CEO of a hedge fund to yell at me over lunch, very politely. But that's what I'm trying to do.
You have it at a great fee rate, too. Like
yeah. So, and obviously things are different in the institutional world because there's less distribution costs and things are different. But I do think what we believe very strongly is every investor should not only have a risk budget, but they should have a fee budget, and they should get the best returns for the fees that they feel comfortable paying. Some people are invariant, just want the best returns. Other people have other demands and say, I only want to pay X, and you want to have the best return per risk, per fee.
Do you think you're going to win that war on fees? I mean, the traditional hedge fund model has made a lot of hedge fund managers extremely wealthy.
Right.
Some of the investors, maybe not so much. But that's a 2% annually plus 20% of the upside. That's sort of the traditional pricing model. Where do you think that model's going?
So I'm foolish enough. I originally in life was a professor, so I was never set out to be a business person, which I think gives me license to do these crazy real experiments. But my point is, I took a group of people and a product out of my former firm, and what we're trying to do is go around and say we're a well-known team, either put up or shut up, quite frankly. You complain about fees, you complain about disclosure, you complain about liquidity. We've got pretty solid returns here. Do you want to do this? And we'll run. And 2 years from now, we'll see. And so either they're going to do that or not. The problem is that when you get into these private markets, it's very opaque in terms of figuring out who's good. There is no Morningstar of the private markets. And so it's very easy to deflect to bigger firms are better and well-known personalities are better, as opposed to just returns.
Lynn, we got a series of questions from the audience, which tells me we're doing something right. So I'm going to throw this one to you, and then Judy and Jane, if you want to jump in as well. The question is a bit counterintuitive. It says, does an increase in passive assets and passive investing like ETFs create more opportunity for active managers? In other words, there are fewer active managers, more of the market is just run by passive funds. Does that create opportunities?
I guess if you look at the full AUM base, you would say, well, as the passive side increases, it would reduce room for the active managers. But I guess on the other hand, you would say that as people go into the plain sort of vanilla equity markets on the passive side, it does provide an opportunity for the active managers to find niche kind of areas that they can sort of sell. And so maybe for a smaller manager, as opposed to the bigger ones, it does provide a way into a market that otherwise seems very hard to break into. That's my thought.
Yep.
Well, I was going to say that I think in the case of active to passive, any good active fundamental manager will prevail. And so performance will rule largely. And I think at the end of the day, too, when you talk about passive versus active can come in ways where even if you're looking at a typical passive sort of ETF vehicle, we have a very robust platform of actively managed factor-based ETFs, which is a different way of applying a passive sort of frame of reference. Right. Now, again, we distinguish ourselves from being passive because we are active managers. And so I think at the end of the day, when you look at the broad pool of assets under management, passive will play a role, but people, to Jane's point, they're going to need performance to serve certain outcomes that they're looking to serve. And that arguably is delivered through active management.
Jane, do you have anything to add on the active versus passive debate?
Active management is critically important. And the reason is that without active management, there's no connect between the fundamental real economy, the businesses that operate, and the financial economy. Otherwise, what's passive? Passive is some index provider, whoever it is, has said these are the people you hold. They don't do any fundamental work on it. There's no realization. And so it's really important that keep connected to the capital markets. So passive is attractive because of the low fees, but as we've seen, at least in the U.S., that as the increase is happening, active managers are doing better for the past 2 years than passive because it's just getting too disconnected.
I've got to throw one more comment in. I was at a conference recently with Mark Wiseman, who was the head of the CPP Investment Board. He's now a senior executive at BlackRock. And he said the decision to go passive is actually an active decision. You are making a decision to take a strategy, and that strategy involves considerable risk. I mean, you are exposed to market risk. You are exposed to negative interest rates and things like that. So just because you're passive doesn't mean you're necessarily risk-free. And I like active managers. They have stories to tell me, so you need those. Again, comment from the crowd, and this is, I think, someone who's thinking about building their career, something that the Canadian Club always encourages. Looking ahead to 2020 and beyond, how can we remain competitive and still attract young investors who have several disruptive tools available on their smartphones? So I think what they're saying is will younger investors continue to come to look to outside managers as opposed to trying to do it yourself off your smartphone, if I'm interpreting the question correctly. Judy, you want to take a first crack at that one?
I mean, with that interpretation of the question.
Yep.
I think, there's always a point in time. Young people may start off as self-directed, think they can do it themselves, might use a robo-platform. Again, you come back to, there is, I think, as I look around the room, there may be some of us who are at that age where you get to a stage in the age of the game where you actually are too busy in your career, too busy with your family, too many other things going on. It's kind of like you need to hire a trainer. You need an advisor. And you need somebody who is going to help guide those decisions and or just take it off your plate, right, to some degree. So the role of the advisor is really critical. And I think young investors are coming into the market. Millennials are going to exceed the amount of baby boomers, I think, this year or next year. I mean, there's going to be tons of them. There's a huge intergenerational transfer of wealth that's going to be happening. They cannot, in my opinion, manage it all themselves.
Judy, I'll stick with you for a moment. You had mentioned a moment ago that AGF has rolled out a number of strategies that used to only be available to very sophisticated, large institutional clients. And now you're offering them basically to the retail investor. So I'm thinking if this is the infrastructure offerings and the ETFs that you highlighted a moment ago. Do you think you're going to see more of that more of the what I would have thought of as institutional strategies are going to become much more mainstream in the future?
Yeah, I mean, I think there's an obvious reason why. I mean, one of the large pension plans was about 5% exposed to alternatives in 2005, and they're over 50% now in 2019. So the demand by institutions keeps increasing on infrastructure and really the alternative space in a private equity format. It's important for retail investors who, as we see, are seeing this double-digit global market go up, stock market go up, but at the same time are seeing negative yielding rates and bonds around the world. That is really a challenge for them in terms of their risk aversity. And so where should they rightly be able to play? And I think the uncorrelated asset returns that you can get from an infrastructure opportunity is something that investors are going to be demanding more and more of. And so to be in a position to offer that, finally the regulators have come to the table a year ago, opened up the framework so that we can offer it in a mutual fund vehicle. Many of the managers around, obviously in Canada, are starting to offer that. And I think it's the way that has to go.
Lynn, do you want to jump on that too? The idea of institutional strategies getting offered into the retail market. Are you seeing that from any of your clients?
Yeah, no, I would agree with Judy. We are definitely seeing institutional mandates coming down into the retail market. That's happened actually over the course of time for years and years. It starts in the institutional market and then it rolls down into the retail market. And so I do think infrastructure, the liquid alt funds is one example of that. That was helped through new regulation. So that's a good result of change in regulation. So I agree, yeah.
We're trying to find something to argue about.
We're trying to argue about it.
Now, I happen to have 2 kids in their 20s, and I'm trying to make them aware of what's going on in markets and trying to get them to invest. And what they've opted for is the Wealthsimple platform. I'm really sorry, Judy.
It's okay. Yeah, I can answer that.
Yeah. Lynn, maybe I'll start with you. Do you want to talk for a minute about this concept of the Roboadvisors as being the future of investment management? Do you want to talk about the risks and the rewards that come with that sort of concept of the Robo-advisor?
Yeah, we started to see the online advisors come onto the circuit about 6-7 years ago, and they've become very popular, doing quite a bit of work in that area of launching new online platforms. And you know, when the clients came to us at the beginning, that was certainly just to answer a very basic market need, that just like we see the whole consumer economy wanting to shop online and do other things online, some people just want to invest online. And I remember working on one of the early online providers, and at that time, the OSC took a position that every investor had to have a call. You couldn't just go online and have no interaction with a person. And that's pretty well-known robo platform now. They said, BLG, you go tell the OSC. Some people just don't want to talk to us. They just want to be online and do everything online, and that's the way they want to go. So I think the online platform arose as an opportunity to deal with the way people want to invest and an evolution in the way people want to invest and run consumer markets, including financial markets. But I think that other opportunities they can be done at a lower cost price point, which helps with bringing lower cost options to the mass retail. I think some of the risks that people are concerned about in the online market is how do we ensure through an online platform that people are getting the discipline or the reminders to invest and to deal with some of the behavioral issues. And the online advisors would certainly say that they are dealing with that they have systems and ways to prompt people to make their regular deposits and also to hold when markets are in turbulence. And I think also we're seeing now the matching of the human advisor with the online platform, which is answering that risk quite well, because now you've got the human putting the behavioral kind of controls and working together with the online platforms that provide the mass kind of low fee structures where it makes sense.
Judy or Jane, any views on where robo-advisors are going? Obviously they're a significant part of the landscape. Do you think the online investor will...
What's interesting is I'm not so familiar with what's happened up here in Canada, but in the States, the robo-advisors have been a lot of flash, but not a lot of delivery. What's interesting, this is just from my world, currency is one of the largest FX trading, foreign exchange trading is one of the largest, most liquid marketplaces. It's very easy to have screens. Reuters screens and other screens have existed a long time to do electronic trading. However, when something big and bad happens, everyone trades back to voice. They actually pick up a phone at these big desks and call other people. There's just something human about that, and I think the real test for the robo-advisors will be when something doesn't work. You can only do so much.
And when's the next crash coming?
Yeah.
That's what we need out of this session.
Well, if I could just comment from an asset management perspective, I certainly agree. I think we've seen robo-advice in Canada since we've had positive markets. So the test will come when the market goes down and how investors respond and how the robo-advice model responds. But for us as an asset manager, we see it as an opportunity as well, because our expectation is we'll be on their platforms. Hence the reason why we've established the ETF platform of product, offer something where we can now be a partner with those robo-advisors.
Question here again from someone I think who's looking at shaping a career in the industry. Do you see the type of talent needed for your firm or for the industry in the future changing radically? Judy, you want to take that first? You do lots of hiring and
hopefully that's
recruiting?
all we're doing.
Yeah.
I think there's different skill sets. So what I talk about on the distribution side, we're looking for individuals who can engage in a different level of dialogue, perhaps requiring a bit more of investment management expertise or knowledge than in the traditional wholesaler model that we've had in the past. That's a transition and development of skills over time for our current team. And we're doing that. When you see it on the investment management side, we obviously have a huge depth of quantitative asset management. Very different skill set. We have an astrophysicist. We have 3 or 4 PhDs on staff. These are teams of people who are brilliant, and it's a very different way of running money than the fundamental asset management. And then if you look at even the back office and the delivery models, marketing, all those skills are to be very much focused on a digital experience and technology savvy. The other area that I see growing, of course, is ESG. And what I not so jokingly say all the time, there's a huge growth in ESG compliance. Because the ability to be able to prove to the regulator that we are doing what we're saying we're doing, we are assessing these factors according to whatever we say we're assessing them, that we're meeting our policies, that's going to be a huge burgeoning business. So ESG compliance.
That's a brand new career that I had never heard of before. Jane, you've taught at universities along with running money. What sort of skills do you see as being valuable to an investment management professional in the future? Yeah,
so I think one of the sad things about the industry is that people tend to think of it very narrow, like they'd love to be stocks. If you're not interested in stocks, there's no place for you. Well, I'm not at all interested in stocks, and I had a very successful career. So the things that we've always looked for, and my firm had a couple hundred people in it, was that you have to be very focused on detail and very careful with what you do. And we would look for diverse thinking. One of the nice things about investing is it's not about winning an argument. The market's going to move, and you're either going to be right or wrong. So in order to have a lot of diversity around the table, if you think of some of the big financial disasters, a lot of them are groupthink. This is what everybody else is doing. Let me hop on the band. So it's kind of lonely to come in, but if you do really strong research and you're backed up by a lot of facts, often the facts can speak for themselves.
Lynn, do you want to add in, even from a law firm, from a legal point of view, and from a law firm's point of view, are there new talents or new skills that you expect will be valued going forward in terms of what your practice looks like?
Yeah, I think we're seeing a lot more disruptions, so we're going to need a lot more expertise on technology, artificial intelligence, how it's playing. When you get into the regulatory analysis, you really need to peel back and get right to the bottom. I agree with ESG. That's an area I think we're going to be needing to really understand with the portfolio manager clients, what is it they're doing, how are they regulating, so we can make sure the disclosure is proper. But I'd agree with attention to detail, and it's keeping up with, when you launch a cannabis fund, you've got to understand exactly what the regulatory environment is and what are the risks, and help the client to disclose those properly so that the investing public knows exactly what it is they're getting and what the risks are.
Does the investment public actually read the risks when they get the 20-page disclosure on the cannabis fund? I'm worried they don't always.
And I know this is maybe, hopefully not, but I can't tell you the number of people who have asked me for jobs over the years that have resumes with mistakes in it. So when we say attention to detail, if you don't, you can tell me your attention to detail, meanwhile you've got 3 misspellings, what do you think? So that's the biggest mistake I see out of young people.
Lynn, I'll come to you on this one because, and then get the other 2 panelists first. This is particular to the Canadian market. What do you feel will be the greatest challenge to succession within the owners of Canadian investment management firms? So, Lynn, you've probably worked with firms that either dealt with succession issues or been part of consolidation. Do you want to talk about the challenges and opportunities?
I thought this was a question for Judy.
I'm going to let her.
I'll leave that.
That's why he was being nice.
I'm going to let the entrepreneurs answer this second. The advisor can answer first. Yeah.
Okay. Well, I do think succession, I think it's just the challenges of the market and making sure that, as things come, you're watching for those changes ahead of time and trying to be prepared for them. For me, any good and successful asset manager I've worked with really starts with a really good team. So I think succession in large part is making sure that there's a team there to support the person who's coming in, and that the team can properly analyze the risks and issues that are coming in and be prepared for them. So now, as I said, I think it's how to deal with fee pressure, how to deal with scale, how to deal with distribution, and those are the things that somebody coming in is going to have to deal with and address, and the disruptions and technology. Yeah.
Thanks. And for those who don't read the Globe every day, and you all should, AGF did go through succession about 6 months ago, absolutely seamlessly. I got to tell that story in the Globe Mail.
Yes.
Judy, you want to weigh in on how to manage succession, having just been through it?
Yeah, well, do it well. I mean, there's a whole process behind it, but I think succession in of itself suggests that you have something with which to pass on. So it is very much about ensuring your business is healthy and ensuring you've got an agile response to all the different disruptions that are happening in today's industry. And with that, frankly, you just have to have good people. And so.
Thank you. Now, I think we're hitting the limits of our time. I've been thrilled to take questions from you. Are there any other questions that people were anxious to ask? And if not, I am looking at my... Oh, I've got about 20 more. But I do realize we're up against, it is 1:15, so we're up against the time limits that.
One more, your favorite one.
Oh boy.
Your last question, what would you do?
Yeah. Sure, Judy. I'll start with this one for you. If you were starting an asset management firm today, do you have any of the the burden of 60 years of history, what would you focus on? What would be...
Burden.
Not a burden. The wonderful opportunities provided by having a great brand. What would your firm look like? This is. I'll take this to Jane because she actually did it. But if you were launching a firm tomorrow, what would that investment management firm look like?
So, I mean, I think the strategies that we're deploying are the correct ones. Of course, I'm going to say that. Moving down a path where we can be ensuring that we're providing diversified asset management. But I think, if I had my druthers, try to prefer a much more streamlined and efficient back office. Because some of the legacy issues that you deal with as a company that's been around 60-something years is just the nature of the business doesn't change quickly enough, particularly from a systems and technology perspective. And that's one of the things that I think we're all responding to now is the speed with which transition is happening with technology is really rapid. And so making sure we do that at the front end is important, but it would be, it's helpful to do that at the back end as well.
There we go. And with that, I can see John's back up.
Thank you, Andrew. And Judy, yeah. Judy, Jane, and Lynn, thank you very much on behalf of the Canadian Club for being here today and walking us through the intricacies of an evolving industry. Your different experiences were really interesting to hear from the different perspectives, and best of luck with the new business, for sure. Andrew, thank you very much as well for guiding the discussion and leading an enriching conversation. Just before we close, we'd like to thank MediaEvents.ca, Canada's online event space, and VVC for live streaming today's event. You can check it all out on our website, review the tape, and check Judy's reaction to the consolidation question. And there's pictures from today as well. But thank you very much for being here. Thank you, everybody, for attending. And to BLG, thank you for sponsoring the discussion. We look forward to seeing everybody again soon. Thank you for a great day. All the best.